What if I told you there's a tool that traders have used for decades to predict where the market could reverse before it happens? It's like having the market's GPS system built into your chart. It's not a crystal ball, it's not a magic trick, it's called the Fibonacci retracement. And if you're not using it, you're probably leaving profits on the table. In this video, I'm going to show you how to use the Fibonacci like a pro to enter better trades, set smarter take profits, and stop getting wrecked by surprise pullbacks. I'm breaking it down so even your grandma could trade with it. The Fibonacci sequence isn't just something from your high school math nightmares. It's actually a sequence of numbers where each number is the sum of the two before it. This series of numbers is derived by starting with 0, followed by 1, and then adding 0 and 1 to get 1, which becomes the third number. Then adding the second and the third number, which is 1 and 1, to get 2, which also becomes the fourth number, and so on. After the first few numbers in the sequence, if you measure the ratio of any number to the succeeding higher number, you get 0.618. For example, 34 divided by 55 equals 0.618. If you measure the ratio between alternate numbers, you get 0.382. For example, 34 divided by 89 is equal to 0.382. Yeah, we will stop there before your brain melts. And no, Fibonacci wasn't an Italian pasta dish. He was a 13th century mathematician. These are the Fibonacci ratios you have to know: 0.236, 0.382, 0.5, 0.618, and 0.786. In trading, these ratios act like magical bound zones. Price love to visit them like a Kalinji X. You won't really need to know how to calculate all of this. Your charting software will do all the work for you. Alright, why does this Asian math wizardry actually work in Forex? Fibonacci retracement levels work on the theory that after big price moves in one direction, the price will retrace or return pathway back to a previous price level before resuming in the original direction. Traders use the Fibonacci retracement levels as potential support and resistance areas. Since so many traders watch these same levels and place buy and sell orders on them to enter trades or place stops, the support and resistance levels tend to become a self-fulfilling prophecy. The first thing you should know about the Fibonacci tool is that it works best when the market is trending. Fibonacci retracement levels are horizontal lines that indicate the possible support and resistance levels where price could potentially reverse direction. These levels that seem to hold the most weight are the 38.2%, which is the 0.382 in decimal value, 50% and 61.8% levels, which are normally set as the default settings of most Forex charting software. The idea is to long or buy on a retracement at a Fibonacci support level when the market is trending up, and to go short or sell on a retracement at a Fibonacci resistance level when the market is trending down. In order to apply Fibonacci levels to your charts, you need to identify swing high and swing low points. As covered in my trend lines video, to identify swing highs and lows, you need to see a significant drive away from a price point. It's either a massive pull from a price point or a gradual but prolonged move away from a price point. Now, this is how to draw the Fibonacci retracement tool. For downtrends, click on the swing high and drag the cursor to the most recent swing low. For uptrends, do the opposite. Click on the swing low and drag the cursor to the most recent swing high. Let's take a look at some examples of how to apply Fibonacci retracement levels to the currency markets. Here, we plotted the Fibonacci retracement levels by clicking on the swing low at 1.2254 around July and dragging the cursor to the swing high at 1.3481. The charting software automatically calculates and shows you the retracement levels. Now, the expectation is that if GBP/USD retraces from the recent high, it will find support at one of those Fibonacci retracement levels because traders will be placing buy orders at these levels as the price pulls back. Now, let's take a look at what happened after the swing high occurred. Price pulled back right through the 23.6% level and continued to shoot down over the next couple of days. It even tested the 38.2% level but was unable to close below it. Later on, around late September, the market resumed its upward move and eventually broke through the swing high. Clearly, buying at 61.8% Fibonacci level would have been a profitable long-term trade. Now, in this downtrend example, we plotted the Fibonacci retracement levels by clicking on the swing high at 1.5823 around late November and dragging the cursor to the swing low at 1.4953. Now, the expectation is that if GBP/USD retraces from the recent low, it will find resistance at one of these Fibonacci retracement levels because the traders will be placing sell orders at these levels as the price pulls back. Now, let's take a look at what happened after the swing low occurred. Price pulled back right through the 23.6% level and continued to shoot up over the next couple of days. Later on, around March, the market resumed its downward move and eventually broke through the swing high. Clearly, selling at the 61.8% Fibonacci level would have been a profitable long-term trade. One thing you should take note of is the price won't always bounce from these levels. They should be looked at as areas of interest. You don't have to use every level. Most traders pay close attention to 38.2%, 50%, and 61.8%. Those are the VIP sections of the retracement club. For now, there's something you should always remember about the Fibonacci tool, and it's that they are not always simple to use. If they were that simple, traders would always place their orders at Fibonacci retracement levels and the markets would trend forever. Let's head over to how to trade using the Fibonacci ratios. It is evident that support and resistance levels eventually break. Well, seeing as how Fibonacci levels are used to find support and resistance levels, this also applies to Fibonacci. Fibonacci retracement do not always work. Let's take a look at an example. You see that the pair has been in an uptrend, so you decided to take out your Fibonacci retracement tool to help you spot a good entry point. You use the swing high and the swing low. You see that the pair has shown a rejection at the 61.8% level. You say to yourself, uptrend, rejection, golden Fibonacci level. Perfect.
Nice.
You long at market and start daydreaming that you'll be driving along the coast in your new Rolls Royce. Now, if you really did put another at that level, not only would your dreams go up in smoke, but your account will take serious hits if you didn't manage your risks properly. Take a look at what happened. Fibonacci retracement levels failed to hold and price broke through for new lows. It turns out that swing high was the peak of the uptrend and the price began to rally below the swing low point. So what's the lesson here? While Fibonacci retracements give you a higher probability of success, like other technical tools, they don't always work. You don't know if price will reverse to the 38.2% level before resuming the trend. Sometimes it may hit 50% or the 61.8% levels before turning around. Heck, sometimes the price will just ignore Mr. Fibonacci and blow past all the levels. That's why you need to hone your skills and combine the Fibonacci retracement tool with other tools in your Forex toolbox to give you a high probability of success. One of the best ways to use the Fibonacci retracement tool is to spot potential support and resistance levels and see if they line up with the Fibonacci retracement levels. Let's take a look at an example of how you can combine support and resistance levels with Fibonacci levels. As you can see, it's been on an uptrend recently. Look at all those orange candles, which of course should be green. My bad. You decide that you want to get in on this long GBP/USD, but the question is, when do you enter? You bust out the Fibonacci retracement tool using the low at 1.5856 for the swing low and a high at 1.6465 for the swing high. Now your chart looks pretty sweet with all those Fibonacci retracement levels. Now that we have a framework to increase our probability of finding a solid entry, we can answer the question, where should we enter? You look back a little bit and you see that 1.6233 price was a good resistance level in the past, and it just happens to line up with the 38.2% Fibonacci retracement level. Now that it's broken, it could turn into support and be a good place to buy. While there's no guarantee the price will bounce from those levels, at least you can be more confident about your trade. After all, there's strength in numbers. Remember that trading is all about probabilities. If you stick to those higher probability trades, then there's a better chance of coming out ahead in the long run. Another good tool to combine with the Fibonacci retracement tool is the trend line analysis. After all, Fibonacci retracement levels work best when the market is trending, so this makes a lot of sense. Remember that whenever a pair is in a downtrend or uptrend, traders use Fibonacci retracement levels as a way to get in on the trend. So why not look for levels where Fib levels line up right smack with the trend? As you can see, the chart has been on a downtrend recently. You identify the recent swing highs and draw your trend line across them, anticipating the third touch to complete the trend line and be a good point for entry. You bust out the Fibonacci retracement tool using the recent high at 1.07781 for the swing high and the low at 0.99548 for the swing low. Price touches the trend line and bounces off at 50% Fibonacci retracement level, solidifying the zone. With an entry here, this could be you enjoying all those profits. Before we continue, you can check out my clear and concise video on how to effectively trade your trend lines, as that can also be a turning point for you. It is very beginner friendly. Just know that that one was using an AI voice. Now the next is candlesticks. If you can tell when buying or selling pressure is exhausted, it can give you a clue of when price may continue trend. Let's take a look at an example to make this clearer. The market is trending upwards, so you identify your swing high and your swing low to place your Fibonacci retracement levels. After marking your Fibonacci levels, price came to the 50% Fibonacci level, but didn't give us a solid candlestick confirmation. However, at 61.8% Fibonacci level, the market created an engulfing candle. This is an example of where candlesticks and Fibonacci levels can combine to solidify entry. See what the market did after. You can check out my candlesticks pattern video that takes you through every candlestick pattern information and how to use them. You can tap the link at the top right corner of the screen to check it out. The general idea is to take profits on a long trade at a Fibonacci price extension level. You determine the Fibonacci extension levels by using 3 mouse clicks. First, click on a significant swing low, then drag your cursor and click on the most recent swing high. Finally, drag your cursor back down and click on the previous swing low. This will display each of the price extension levels, showing both the ratio and corresponding price levels. The popular levels here are 1.272, 1.618 and 2.0. If you've entered a retracement, these give you calculated exit zones. Many traders love 1.618. It's like the golden take profit zone. Think of it as a market sweet spot. Probably just as important as knowing where to enter or take profits is knowing where to place your stop loss. You can't just enter a trade based on fib levels without having a clue where to exit. Your account will just go up in flames and you forever blame Fibonacci, cursing its name in Italian. These are the simple ways to set your stop loss and the rationale behind each method. The first method is to set your stop loss just past the next Fibonacci level. If you were planning to enter the 38.2% fib level, then you'd place your stop beyond the 50% level. If you felt like the 50% level would hold, then you'd put your stop past the 61.8 level, and so on and so forth. Now, setting a stop just past the next Fibonacci retracement level assumes that you are really confident that the support or resistance area will hold. The market might shoot up, hit your stop, and eventually go in your direction. This is usually where you go to a corner and start sitting your head on the wall. It might be best if you use this type of stop loss placement method for short-term intraday trades. Now, if you want to be a little safer, another way to set your stops would be to place them past the recent swing low or the recent swing high. For example, when the price is in an uptrend and you are in a long position, you can place a stop loss just below the latest swing low, which acts as a potential support level. This type of stop loss placement would give your trade more room to breathe and give you a better chance for market to move in your favor. Remember, stop loss placement isn't a sure thing, but if you can tilt the odds in your favor by combining multiple tools, it could help you give you a better exit point, more room for your trade to breathe, and possibly a better reward to risk ratio trade. And there you have it, Fibonacci 2 demystified and ready to boost your trading game. Remember, it's not a crystal ball, but when used with other tools and solid analysis, is incredibly 007 out of 4. Smash that like button if you learned something new, subscribe for more smart trading strategies, and let me know in the comments what's your favorite fib level. Until next time, trade smart, stay patient, and may the pips be in your favor.